get the replacement property.
The idea was is that Starker was the taxpayer and he wanted to give up property.
Right.
So he went down to his accountant and he says, I'm going to sell my property. It's a bunch of timberland
Right.
up in the Northwest. And the accountant said, well, I don't think I'd do that because if you sell it, it's a taxable event. There's a big liability. You don't want to do that. He says, well, get me out of this. How do I do it? The accountant advanced the notion, well, there's an exchange. You can do an exchange. And he says, well, how can I find somebody who wants my forest land and I want their property to do an exchange? And so they came up with this idea that he could give his land to a third party effectively and then go out and buy other property and call that an exchange, even though the events did not occur simultaneously and even though they were not an exchange in the one-to-one sense. And throughout the 70s, there was a lot of litigation on this case, and finally in 1979 we had the Starker decision, which in effect approved this non-simultaneous deferred exchange, and of course that's why we call it the Starker exchange. And of course I often wonder sometimes, what if it was called the Ostremski exchange, or the you know, some long name that we couldn't pronounce. But fortunately, it's the Starker exchange.
Right. And so then what happened is, because the transaction happened over many years, the IRS said, well, wait a minute.
Correct.
We can't even go back because the statute could be closed.
Right. Their first reaction was it really was a sale followed by a purchase, which is very distinguished.
Yeah.
But yet the court in the Ninth Circuit, which covers, of course, our area here in Northern California, the Ninth Circuit Court found an exchange pursuant to the tax code, so we had no taxable event for those people.
Right. Anyway, so then they came out with some new rules. Well, we'll go through those new rules in a few minutes. They're not so new now.
1991. Well, 19 years just threw them in, you know.
Time flies when you're having fun.
Exactly.
So, however, what we have here, though, as you said, if you're exchanging one type of asset, well, you didn't mention cash, but if it's, you know, like if I'm a child and I've got some jacks and I want to exchange it for somebody else's ball, well, those are two different types of property. That could be a taxable exchange.
Correct, correct.
But if you have what we call like-kind property, then we've got the tax deferral.
Right. Well, there's three basic elements that 1031 requires. Number one, the property that you give up and the property that you acquire have to be held for investment or used in a trade or business in a productive way. That's number one.
Right.
The second condition is the transaction itself has to be an exchange. And ordinarily we think of two people trading, like the ball and the jacks.
Yeah.
But we've just seen from the Starker case and the cases that have come later that the exchange really is an expanded thing that could be a sale followed by a purchase on two independent transactions. And the third thing is like kind. Now for real estate, very fortunately, real estate like kind means that we have properties that are basically investment real estate. So for example, a piece of raw land is like kind to a single family home which is used as a rental property. An office building is like kind to a gas station real estate. And it goes on and on. The regs are very clear about that.
Yeah, so it's actually very flexible for real estate as far as what's like kind.
Right, and just as a footnote, non-real estate, things like equipment and those types of things are also eligible for this rule, but the rules are very much narrow. I mean, so for example, a computer is a piece of equipment that's not real estate. That's not like kind to a tractor, even though they could be used in business.
Yeah, and actually then the IRS sort of liberalized that. We're not going to get into any depth here because we're mostly talking about real estate.
Correct.
But they have made like classes of property
correct.
that you can actually make exchanges
Well,
for.
again, I think our focus today is all about, this opens the discussion, this doesn't answer the questions.
Yeah. So let's move along. So can an exchange, a tax-deferred exchange, can it actually result in taxable income?
Yes, sure, it sure can. The code itself calls out two different types of properties in the tax code under Section 1031. So let's say, for example, that, and we'll just talk about an easy exchange here. Let's say, for example, that I have a property that I sell for $1 million and I go through this exchange process. And I set it all up. And generally speaking, from a numerical point of view, one of the fundamental mathematical rules of exchange is if I sell for $1 million, I have to buy for $1 million or more. And I'm not talking about equity, I'm talking about the sale price of the property, perhaps minus commissions and so forth. So I sell the property for $1 million minus my commissions, and I find you've got property for sale, and you sell it to me for $800,000. At the end of the program, when I've sold and then when I bought your $800,000 property, there's a difference. There's $200,000. In the most simple example, I'm going to receive that in cash.
Right.
And so when you evaluate that transaction, I've given up $1 million in real estate, and I've received $800,000 in real estate and $200,000 in cash. Cash is not eligible for the rule. Cash is not like kind of real estate. So the $200,000 is said to be boot in that example.
Yes.
And boot is something on which gain can be recognized.
Right. And so what happens is that the amount of the gain up to the boot that you receive is taxable.
Correct.
Yeah.
There's a general rule, they call it, your taxable gain is going to be the greater of the boot or the realized gain. So let's go back to that example real quickly. Let's say I sell that property for $1 million, and let's ignore an exchange. Let's say that I bought that property a long time ago for $300. I sell it, and I have a $700 gain for the sake of simplicity. Now, if I just sell it and I don't do an exchange, I don't acquire other property, my gain would be $700. I would pay tax on the $700 based on the rates and so forth. Now, add in the facts that I buy this property for $800 from you, so I have a partial exchange, shall we say. So now what I've received in return is I've got $200 cash and $800 in like-kind property. So that's a measure of the boot, which is $200. The gain, the taxable gain for my purposes, is the lesser of those amounts, so it would be the $200.
Right. Now, how do liabilities play into this?
Very, very interesting question. The easiest way to answer that is if you're trying to evaluate that simple transaction, which we often call the napkin test, by the way, because there was a lawyer who invented it one day, and he was describing it to his friend on a table very similar to this.
Okay.
And he wrote it out on a napkin, and he
Okay.
explained how this $1 million versus the $800 in the boot. So that's a
Right.
napkin test. Now, a lot of times when I sell my $1 million property in this example, I'm going to pay off a mortgage, and I'm going to get some cash. So let's say, for example, I have an existing debt of $400,000 on that loan or on that property. I sell for $1 million. I'm going to net $600,000. Okay. Now, when I go out and buy the $800,000 property from you, I'm still going to have that boot situation. I'm still going to have that $200,000. In this case, it may be characterized as money that I get, the other $200,000, or it could be that I have less debt on the next property. I might have a $200,000 debt. So it's possible that they have a debt relief, and that is said to be a net debt relief, which is the same. It's just like receiving cash. It's very similar.
Right. So, but that's a tripping area for many people. Is They
Yes.
think, I didn't get any cash out of this
Correct.
deal. How could it be taxable?
Yeah. So let me just run through that example again. So your common do-it-yourselfer says, okay, I want to sell this property. And this is really common. I've had this conversation many times. So the taxpayer comes in after the fact, of course. So they always tell you the problem on April 1st. You know,
Of course.
from last year. Now, here's my paperwork, Mike. Now fix it. You know,
Yeah.
make it go away. So I sell this property. I've got $600,000 cash left over. The real estate agent perhaps has said, well, just reinvest your equity. So they sell for $1 million. They buy $600,000 over here, and they've bought down by $400.
Right.
Okay, and they come in and they're all proud. First they say, well, I got rid of my debt, so you're proud of me because you're an accountant and you're really conservative. And the other thing is that I exchanged, so you're really happy with me because I'm not paying taxes because I did an exchange. And you say, au contraire, the problem is you have $400,000 of debt relief. That's really a monetary benefit, and that in that fact pattern that becomes the boot.